Let me tell you something that took me decades to truly understand. The difference between good investors and great investors isn't intelligence. It is not access to information. It is not even experience. The difference is understanding which businesses will compound wealth relentlessly, year after year, regardless of what is happening in the broader economy. I started Citadel in 1990 with $460,000. Today, it is one of the largest and most successful hedge funds in the world. Along the way, I've analyzed thousands of companies, made billions of dollars, and lost billions of dollars. I've seen bull markets that seemed unstoppable and crashes that felt like the end of capitalism. And after all of that, if you asked me to start over today with nothing but my knowledge, if you told me I could only own 4 stocks for the next decade, I wouldn't hesitate. I know exactly which 4 companies I'd choose. Not because they're the most exciting, not because they're going to double next month, because they represent the highest probability of compounding wealth over a 10-year horizon with manageable risk. Today, I am going to share those 4 stocks with you. More importantly, I am going to explain the framework that led me to choose them. Because understanding why these companies are exceptional matters more than memorizing ticker symbols. Let me start with a story that shaped how I think about stock selection. Early in my career, I was obsessed with finding the next big thing, the stock that would triple in 6 months, the hidden gem nobody else had discovered. I spent countless hours searching for these opportunities, and occasionally I found them. But you know what I discovered? Those big wins were often offset by big losses. The stocks that could triple could also go to zero. The volatility was enormous. Meanwhile, I watched some of the most successful investors in history do something completely different. They bought exceptional businesses at reasonable prices and held them for years, sometimes decades. They didn't try to predict which biotech company would get FDA approval or which tech startup would be the next Amazon. They bought proven winners and let compound interest work. The math is brutally simple. If you can compound at 15% per year for 20 years, you turn $100,000 into over $1.6 million. If you can compound at 20%, that same 100,000 becomes over 3.8 million. You don't need to find 10 baggers. You need to find businesses that can compound reliably and then have the patience to let them do it. That insight changed how I invest. I stopped looking for lottery tickets and started looking for compounding machines. Businesses with such powerful competitive advantages that their success is almost inevitable. Businesses that generate so much cash they can reinvest, pay dividends, and buy back shares all at the same time. Businesses run by management teams that think in decades, not quarters. When I evaluate a potential investment, I ask 5 questions. First, does this business have a durable competitive advantage? I am not talking about a temporary lead. I am talking about structural advantages that are nearly impossible to replicate. Network effects, switching costs, scale economies, brand power, regulatory moats. If the advantage can be competed away in 5 years, it is not durable enough. Second, is the business getting stronger or weaker over time? Some companies are fighting against secular decline. They're in industries being disrupted, facing demographic headwinds, or dealing with commoditization. I don't care how cheap they look. Fighting gravity is exhausting. I want businesses where the tailwinds are at their back, where every year they get a little more dominant. Third, does management allocate capital intelligently? This is crucial and often overlooked. A business generates cash. What happens to that cash determines shareholder returns. Does management invest it in high return projects? Do they make sensible acquisitions? Do they return excess cash to shareholders through dividends and buybacks? Or do they waste it on empire building, overpriced deals, and perks? I want management teams that treat shareholder capital like their own money. Fourth, is the valuation reasonable? Even the best business is a bad investment at the wrong price. I am willing to pay a premium for exceptional quality, but there are limits. I want to see a path to attractive returns, even if the valuation multiple doesn't expand. I want to buy businesses where the earnings growth alone will generate good returns. Fifth, can I understand this business well enough to hold it through adversity? At some point, every stock drops. Headlines turn negative. Analysts downgrade, the price falls 30 or 40%. In those moments, if you don't deeply understand why you own something, you'll sell at exactly the wrong time. I only own businesses I understand well enough to buy more when they're down. With that framework in mind, let me tell you about the 4 stocks I'd buy if I were starting over in 2020. 6. The first stock is Microsoft. If I could only own one stock for the next decade, it would probably be Microsoft. This company has one of the widest moats in the technology industry, multiple growth drivers, exceptional management, and a track record of intelligent capital allocation. Let me explain why Microsoft is so exceptional. Start with the core business, the enterprise software that runs virtually every large organization on Earth. Microsoft 365, the subscription version of Office, is used by over 300 million commercial users. Think about that number. 300 million people paying monthly subscriptions to use Word, Excel, PowerPoint, Outlook, and Teams. That is recurring revenue that is incredibly sticky because switching away from Microsoft is extraordinarily painful for organizations. I've seen companies try to migrate away from Microsoft. The costs are enormous. The productivity losses during transition are significant. The retraining requirements are substantial. Most organizations just stay with Microsoft because it works, because everyone knows how to use it, because it integrates with everything else. That is the definition of a moat. Then there is Azure, their cloud computing platform. This is where the real growth story lies. Azure is the number 2 cloud platform behind Amazon Web Services, but it is growing faster because enterprises trust Microsoft. These are the same departments that have been buying Microsoft products for 30 years. When they move to the cloud, they naturally gravitate toward Azure because they have existing relationships, existing contracts, existing expertise. Cloud computing is still in the early innings. Most enterprise workloads haven't moved to the cloud yet. The market is growing at double digits and will continue growing for years. Microsoft will capture a substantial share of that growth because of their enterprise relationships and hybrid cloud capabilities. And now there is artificial intelligence. Microsoft's partnership with OpenAI and their integration of AI across their product suite represents perhaps the biggest opportunity in the company's history. They're embedding Copilot, their AI assistant, into every Microsoft product. They're charging extra for it. And enterprises are paying because the productivity gains are real. Think about what AI means for Microsoft's business model. They already have 300 million paying users. If they can charge an additional $30 per month for AI capabilities, and even a fraction of those users adopt, that is billions in additional high-margin revenue. They don't need to find new customers. They just need to sell more to the customers they already have. The management team under Satya Nadella has been exceptional. When Nadella took over in 2014, Microsoft was seen as a declining tech giant stuck in the past, losing relevance. He transformed the company by embracing cloud, embracing open source, embracing mobile. He made hard decisions about what to focus on and what to abandon. The stock has increased more than tenfold under his leadership. Capital allocation has been outstanding. Microsoft generates over $70 billion in free cash flow per year. They pay a growing dividend. They buy back shares consistently. They make strategic acquisitions like LinkedIn and the gaming companies. They invest heavily in research and development. They're doing everything right with shareholder capital. The valuation isn't cheap. Microsoft trades at a premium to the market, but for a business of this quality, with these growth drivers, with this management team, I am willing to pay up. The earnings growth alone should generate attractive returns, even if the multiple compresses somewhat. Let me give you a concrete example of Microsoft's competitive position. A few years ago, I was talking to the CIO of a Fortune 500 company. He told me they had looked at moving off Microsoft to save money on licensing fees. They estimated they could save about $50 million per year by switching to alternatives. Then they calculated what the switch would actually cost. Retraining hundreds of thousands of employees, rebuilding integrations with other systems lost productivity during the transition, consultant fees, parallel systems during migration. The total cost was over $200 million. And that didn't account for execution risk. They stayed with Microsoft. Of course they did. The switching costs made it irrational to leave, and that is true for almost every large enterprise. They're locked in, and Microsoft can raise prices gradually, knowing that customers will complain but won't leave. That is what a moat looks like in practice. Not just having the best product, but having structural barriers that keep customers even when they're unhappy. Microsoft has built those barriers over decades, and they're getting stronger, not weaker. Microsoft is the closest thing to a sure thing in the stock market, not guaranteed. Nothing is guaranteed, but as close to inevitable as you'll find. The second stock is Visa. Visa is one of the most beautiful business models I've ever studied. They sit at the center of global commerce, taking a small fee on trillions of dollars in transactions, with almost no capital requirements and incredible margins. Let me explain why Visa is so powerful. Visa doesn't actually lend money. They don't take credit risk. When someone defaults on their credit card bill, that is the issuing bank's problem. Not Visa's. Visa just operates the network that connects merchants and banks. They process transactions and take a small fee, usually around 20 basis points of the transaction value. 20 basis points sounds tiny, but when you are processing $15 trillion in annual payment volume, 20 basis points is $30 billion in revenue. And because operating the network is mostly fixed costs, servers and software and employees who are already there, incremental transactions drop almost straight to the bottom line. Operating margins are around 70%, net margins are around 50%. These are some of the best economics in any industry. The moat is extraordinary. Visa has over 4 billion cards in circulation. They're accepted at over 100 million merchant locations worldwide. Every bank in the world wants to issue Visa cards because consumers demand them. Every merchant wants to accept Visa because customers have the cards. It is a classic two-sided network effect that is nearly impossible to disrupt. Cool a competitor, build a rival network. In theory, yes. In practice, it would take decades and billions of dollars. And even then, you'd have to convince merchants and consumers to switch from something that already works perfectly. No rational competitor would attempt it. That is why the payment network industry is essentially a duopoly between Visa and MasterCard. The growth story is compelling. Despite being a massive company, Visa is still growing revenues at double digits. Why? Because the world is still shifting from cash to electronic payments. In developed markets, this shift is well advanced but not complete. In emerging markets, it is just beginning. Billions of people are entering the formal economy, opening bank accounts, getting payment cards for the first time. That is decades of growth ahead. Then, there is the shift from in-person to online commerce. E-commerce is still growing faster than physical retail, and every online transaction requires an electronic payment. Visa wins either way, but they win more as commerce moves online. New payment flows represent another growth vector business. Business payments, government disbursements, cross-border remittances, these are enormous pools of transactions that are still largely handled by checks and wire transfers. Visa is building products to capture these flows. The addressable market is far larger than consumer payments alone. Management has been disciplined and shareholder-friendly. They return virtually all free cash flow to shareholders through dividends and buybacks. They make small, sensible acquisitions. They invest in technology to stay ahead of potential disruptors. They think long-term about protecting the franchise. The valuation is premium, but justified. Visa trades at a higher multiple than the average company, but their growth rate, margins, and competitive position are far above average. For a business this dominant, with this much runway, I am willing to pay up. Visa is a toll booth on global commerce. As long as people are buying things, Visa is making money. That is exactly the kind of business I want to own for the next decade. Let me share a story that illustrates Visa's power. Several years ago, there was talk about cryptocurrencies replacing credit cards. Bitcoin was going to revolutionize payments. Blockchain would eliminate the need for intermediaries like Visa. You know what happened? Nothing. Crypto turned out to be a speculative asset, not a payment system. Nobody actually uses Bitcoin to buy groceries. The transactions are too slow, the fees are too high, the volatility is too extreme. Meanwhile, Visa just kept processing trillions of dollars in transactions, quarter after quarter, year after year. This pattern repeats constantly. People predict that something will disrupt Visa, whether it is PayPal, Apple Pay, buy now, pay later services, or whatever the latest trend is. And yet Visa keeps winning because they're not competing with these services, they're enabling them. Apple Pay runs on Visa rails. PayPal transactions often involve Visa cards. Buy now, pay later companies use Visa for disbursements. The supposed disruptors are actually customers. That is what people miss about Visa. They're not a product that can be replaced. They're infrastructure that other products build upon. It is like saying someone will disrupt the highway system, maybe eventually, but not anytime soon. And probably whoever does it will end up paying tolls anyway. The third stock is United Health Group. Healthcare is one of the largest sectors of the economy, and it is growing inexorably as populations age and medical technology advances. United Health is the dominant player, with positions across the entire healthcare value chain. Let me explain why United Health is so well positioned. The company operates in two main segments. United Healthcare is the insurance business, the largest health insurer in the country with over 50 million members. Optum is the healthcare services business, which includes pharmacy benefits, management, healthcare delivery, and health data analytics. What makes this combination so powerful is the integration. United can use data from their insurance business to improve outcomes in their services business. They can steer patients to Optum facilities, creating efficiencies that benefit everyone. They can negotiate better rates because of their scale. Each business makes the other more valuable. The insurance business benefits from scale economies that are almost impossible to replicate. United has the largest membership base, which gives them the most bargaining power with hospitals and doctors. They have the most data on healthcare costs and utilization, which allows them to price policies more accurately. They have the most diversified risk pool, which reduces volatility. A new entrant would need decades and tens of billions of dollars to match their scale. The Optum business is growing faster than the insurance business and has higher margins. Optum Health operates thousands of clinics and employs tens of thousands of doctors. They're essentially becoming a healthcare delivery system, which is where the industry is heading. For-service medicine is being replaced by value-based care, where providers are rewarded for keeping patients healthy rather than for performing procedures. United is at the forefront of this transition. OptumRx is one of the largest pharmacy benefit managers, negotiating drug prices for insurers and employers. This business benefits from scale and switching costs. Once an employer is set up with OptumRx, changing PBMs is a complex process that most companies avoid. Optum Insight provides data analytics and technology services to other healthcare organizations. This is a high-margin, recurring revenue business that benefits from United's unmatched data assets. The demographic tailwinds are powerful. The baby boom generation is aging into Medicare, the government insurance program for seniors. United is the largest Medicare Advantage insurer, and Medicare Advantage is growing faster than traditional Medicare because it offers better benefits every day. For the next decade, more Americans will turn 65 and become eligible for Medicare. That is built in growth. Healthcare spending as a percentage of GDP has increased almost every year for decades. As medical technology advances, as new treatments become available, as populations age, healthcare spending will continue growing. United is positioned to capture a disproportionate share of that spending growth. Management has been excellent at capital allocation. They've made strategic acquisitions that expanded their capabilities. They've invested in technology and data infrastructure. They return excess cash to shareholders through dividends and buybacks. They think long-term about building the franchise. The regulatory environment is a risk. Healthcare is heavily regulated, and policy changes could impact the company. But United has navigated regulatory changes successfully for decades. They have lobbyists and lawyers who understand the political landscape. They adapt to new rules better than smaller competitors. Regulatory complexity is actually a moat because it raises barriers to entry. United Health isn't exciting, it won't double in a month, but it is a dominant company in an essential industry with decades of growth ahead. That is exactly what I want for long-term compounding. Let me tell you why I am so confident in United Health's durability. Healthcare is one of the few sectors where demand is essentially guaranteed to grow. People get sick, people get old, people want better treatments. No matter what happens to the economy, no matter who is in the White House, no matter what technological changes occur, people will still need healthcare. And within healthcare, United Health has built a position that is almost impossible to attack. Their scale gives them bargaining power that no competitor can match. They negotiate the lowest prices from hospitals, the best rates from drug companies, the most favorable terms from doctors. Smaller insurers simply can't compete on cost because they don't have the volume to command the same discounts. I've seen smaller health insurers try to compete with United on price. They offer lower premiums to win customers. For a year or two, they might gain market share, but eventually their costs catch up because they're paying more to providers. They have to raise premiums or exit the market. United just waits them out, knowing that scale wins in the long run. The Optum build-out is what makes United Health truly special for the next decade. They're not just ensuring healthcare, they're delivering healthcare. They own the doctors, they own the data, they own the technology platforms. As healthcare shifts from fee-for-service to value-based care, United is positioned on both sides of the transaction. They're the house, and the house always wins. The fourth stock is Amazon. Amazon might seem like an obvious choice, but the reasons to own it go deeper than most people understand. This is not just an e-commerce company. It is an infrastructure provider that is becoming essential to the modern economy. Let me explain why Amazon is still exceptional. Start with the e-commerce business. Yes, growth has slowed from the hypergrowth days, but Amazon is still gaining share of retail spending. They've built a logistics network that no competitor can match. Hundreds of fulfillment centers, thousands of delivery vehicles, same-day delivery in most markets. That infrastructure was incredibly expensive to build, which is precisely why it is a moat. No one else is going to spend the hundreds of billions required to replicate it. Prime membership is genius. Over 200 million people pay Amazon an annual fee for faster shipping. That fee creates switching costs, because once you've paid, you want to get your money's worth. It creates loyalty because Prime members naturally default to Amazon when they need to buy something. It subsidizes the shipping costs that would otherwise eat into margins. Prime is the most effective customer loyalty program ever created. But the real crown jewel is Amazon Web Services. AWS is the dominant cloud computing platform with about a third of the market. It is growing at double digits with operating margins above 30%. If AWS were a separate company, it would be one of the most valuable technology companies in the world. What people don't fully appreciate is how sticky AWS is. When a company builds their applications on AWS, they're using Amazon's proprietary tools, databases, machine learning services, security infrastructure. Migrating away would require rewriting code, retraining staff, accepting months of reduced productivity. Companies just don't do it. Once you are on AWS, you stay on AWS. The cloud market is still growing rapidly. Enterprises are moving more workloads to the cloud, not fewer. Artificial intelligence requires massive computing resources that most companies can't afford to build themselves. They'll rent them from cloud providers like AWS. The addressable market is enormous and expanding. Amazon's advertising business is an underappreciated asset. When people search for products on Amazon, they have purchase intent that makes Amazon ads incredibly effective. The advertising business is now generating over $40 billion in annual revenue, with margins estimated above 70%. That is pure profit that flows straight to the bottom line. The company is investing heavily in artificial intelligence. They're building their own AI chips to reduce costs. They're integrating AI into Alexa and their e-commerce recommendations. They're offering AI services through AWS. Whether AI fulfills the hype or not, Amazon is positioned to benefit. What impresses me most about Amazon is the culture. This is a company that genuinely thinks in decades. They sacrifice short-term profits for years to build infrastructure and customer loyalty. They're willing to fail on new ventures because the occasional big success more than compensates. They hire exceptional talent and give them autonomy to innovate. That culture is a competitive advantage that is almost impossible to replicate. Jeff Bezos stepped back from day-to-day operations, but the culture he built persists. Andy Jassy, the current CEO, built AWS from scratch. He understands what makes Amazon special and is continuing to invest for the long term. The valuation looks expensive on trailing earnings, but Amazon has been investing so heavily that reported earnings understate the true earning power. As growth investments mature and capital expenditures normalize, margins should expand significantly. The stock is not as expensive as it appears. Amazon is one of the few companies that could plausibly be worth trillions of dollars more a decade from now. The combination of e-commerce, dominance, cloud leadership, advertising growth, and AI optionality creates a rare opportunity for long-term compounding. Let me share a perspective on Amazon that most people miss. People think of Amazon as a retailer. That is like thinking of Apple as a phone company. It is technically true, but misses the bigger picture. Amazon is fundamentally an infrastructure company. They've built the infrastructure for e-commerce, the warehouses, the logistics network, the delivery fleet, the fulfillment technology. They've built the infrastructure for cloud computing with AWS. They've built the infrastructure for digital advertising within their marketplace. They've built the infrastructure for voice computing with Alexa. When you own infrastructure, you don't need to win every battle. You just need people to use your infrastructure. It doesn't matter which products win on Amazon's marketplace. Amazon takes a cut of all of them. It doesn't matter which apps succeed on AWS. Amazon takes a cut of the computing. Infrastructure owners capture value regardless of which surface. Level competitors win. That is why I am less worried about competition than most analysts. Sure, Walmart is improving their e-commerce. Sure, Microsoft is competing in cloud. Sure, Google is competing in advertising. But Amazon's infrastructure advantages are so deep that competitors are fighting for scraps, while Amazon captures the core economics. The company's willingness to sacrifice short-term profits for long-term position is remarkable. For years, Amazon was criticized for not being profitable. Analysts complained that they were giving away the store, that their margins were too low, that they would never make money. But management understood something the critics didn't. They were building an unassailable competitive position that would generate profits for decades. Now that position is built, the infrastructure exists, competitors can't replicate it, and Amazon can gradually harvest the profits while continuing to invest in new growth areas. The best is yet to come. Now let me talk about what these four stocks have in common, because the pattern matters more than the specific names. All four have dominant competitive positions in their industries. Microsoft dominates enterprise software. Visa dominates payment networks. United Health dominates healthcare insurance and services. Amazon dominates e-commerce and cloud computing. Dominance creates pricing power, which creates margins, which creates the cash flow that funds reinvestment and shareholder returns. All four are getting stronger over time, not weaker. Their competitive advantages are expanding, not eroding. Network effects are deepening. Scale advantages are growing. Switching costs are increasing. Every year that passes makes it harder for competitors to challenge them. All four have multiple growth drivers. They're not dependent on a single product or market. Microsoft has cloud, AI, gaming, and enterprise software. Visa has payment volume growth, new payment flows, and geographic expansion. United Health has Medicare growth, Optum expansion, and healthcare cost trends. Amazon has e-commerce, AWS advertising, and AI diversification within each company reduces risk. All four generate massive free cash flow that management allocates intelligently. They invest in growth where returns are attractive. They return excess cash to shareholders. They don't waste money on vanity projects. That capital discipline compounds wealth for shareholders. All four have management teams that think long-term. They're not optimizing for the next quarter's earnings. They're building franchises that will dominate for decades. That long-term orientation aligns with how I want to invest. Let me address some potential objections. Some people might say these stocks are too expensive. It is true that none of them are trading at distressed valuations, but I'd rather pay a fair price for an exceptional business than a cheap price for a mediocre one. Over a 10-year horizon, business quality matters far more than entry valuation. These companies will compound earnings at high rates for years. That earnings growth will drive returns, even if multiples stay flat or compress. Some people might say these stocks are too big to grow. It is true that trillion-dollar companies can't double as easily as small caps. But I am not looking for stocks that will double in a year. I am looking for stocks that will compound at 15 or 20% annually for a decade. These companies can do that because their addressable markets are enormous and growing. Some people might say I am ignoring smaller, more innovative companies. That is true, and it is intentional. I don't know which startup will be the next Amazon. Nobody does. Most startups fail. The few that succeed are impossible to identify in advance. I'd rather own today's proven winners than bet on uncertain futures. Some people might say these are all U.S. companies. That is true, but these are global businesses. Microsoft sells software in every country. Visa processes payments worldwide. Amazon operates in dozens of markets. They give you exposure to global growth through US-domiciled companies with strong corporate governance. Let me close with some thoughts on implementation. If I were building a portfolio from scratch, I'd start with equal weights in these four stocks, 25% in each. Then I'd rebalance periodically, perhaps annually, to maintain roughly equal weights. I'd invest gradually, not all at once. Dollar cost averaging over 6 to 12 months reduces the risk of buying at a temporary peak. Market timing is impossible, so I'd just invest systematically regardless of what headlines say. I'd reinvest dividends. Microsoft, Visa, and United Health all pay dividends. Amazon doesn't, but the others do. Reinvesting those dividends adds to your share count, which adds to your future dividends, which creates a compounding effect. I'd ignore the noise. These stocks will have bad quarters. They'll face negative headlines. Analysts will downgrade them. The stocks will drop 30% at some point when that happens. I wouldn't sell. I'd buy more. The fundamentals are strong. Short-term volatility is noise. I'd stay patient. The power of compounding requires time. A 10-year holding period is the minimum. 20 years is better. The longer you hold exceptional businesses, the more wealth you accumulate. Patience is the hardest part of investing, but it is also the most important. These four stocks, Microsoft, Visa, United Health, and Amazon, represent the highest probability path to long-term wealth creation I can identify. They're not speculative bets. They're not exciting story stocks. They're dominant businesses that will almost certainly be larger and more profitable a decade from now. If I were starting over in 2026, these are the four stocks I'd buy. Not because I am certain they'll outperform every alternative. Nothing in investing is certain, but because the probability of good outcomes is high, the probability of catastrophic outcomes is low, and the expected value over a decade is excellent. That is how I think about investing, not as a game to win or lose, but as a process of accumulating high probability bets with favorable expected values. Do that consistently for decades, and wealth takes care of itself. Start with quality, add patience, let compounding work. That is the formula. It is simple, but it is not easy. Most people can't stick with it. They chase excitement, they panic during drawdowns, they sell winners to buy lottery tickets. Don't be most people. Buy great businesses, hold them forever, get rich slowly. That is what I'd do if I were starting over. That is what I think you should do too.